IRCTC ended the fiscal on a strong note with marginal impact of Omicron wave in Q4 and saw revival in its catering business and continued strength of internet ticketing. Revenue share with railways retrospectively for the packaged drinking water business suppressed the segments and the overall margin. With the stock down 18% in the past 3.5 months against 5% decline in the Nifty over the same period, the stock is close to our blue sky fair value. FY23 could turn out to be an exceptional year for the sector. With markets gyrating, investors can look to add the stock on correction. Q4 FY22 maintained the momentum, with overall revenue 3.5% short of the pre-pandemic levels. Although ticketing volumes and sequential revenue were lower due to Omicron in the early part of the quarter, with sustenance of the stellar margins, almost the entire profit was driven by internet ticketing. The share of non-convenience fees, advertising, e-wallet charges, etc. is inching up and formed close to 33% of the internet ticketing revenue. Catering made a sharp recovery with a sequential growth of 154% thanks to resumption of cooked food in trains and progress in tendering process for catering. Rail niche saw improvement in top line sequentially, but profits suffered as 15% profit sharing with the Ministry of Railways was remitted in the quarter retrospectively. In tourism, the Tejas trains are yet to break even, but they're doing better with easing of lockdowns. Should COVID remain an endemic, FY23 could turn out to be a big year for IRCTC. IRCTC now has a share of 82% in the total rail ticketing, and this share is only likely to go up. Post-pandemic, however, ticketing got a boost from the conversion of unreserved general category to a seating class 2S. And these tickets being sold by IRCTC made for nearly 36% of the volumes. The Ministry of Railways has decided to discontinue this from July, and that might impact volumes and revenues partially. The introduction of reservation in suburban and new trains remains a long-term possibility. In the near term, the kicker remains the growth in non-convenience fees that should look up with the revival of the economy. Internet ticketing continues to be the crown jewel and a key risk. While the convenience fee sharing with the Ministry of Railways has been withdrawn, IRCTC doesn't have any control over such decisions, and in an event of any adverse decision like this, it can at best increase convenience fees to partially make up for its lost cash flow. Catering should return to pre-COVID days in the next couple of quarters with the completion of tendering. IRCTC has a 40% profit sharing with railways in the catering business. Rail niche should also see better capacity utilization, and the long-term driver would be the planned capacity addition. In tourism, IRCTC is restarting all the flagship special trains and introducing several new routes, and FY23 therefore could turn out to be an eventful year. While IRCTC continues to enjoy monopoly in three key businesses: ticketing, catering and packaged drinking water, imposition of profit or fee sharing in internet ticketing and an end to the monopoly in all the businesses is a key risk that investors cannot ignore. Despite its uniqueness, the valuation prima facie appears stretched. An expensive stock like IRCTC is especially vulnerable in the current milieu, where the risk of trade triggered by global central banks' war against inflation is shaving off the froth in all risky assets. However, a deep correction could offer an entry opportunity to investors as the prospect for IRCTC looks exciting in the days ahead. Valuing IRCTC's individual businesses using a sum-of-the-part method, comparing it to peers, profitable OTA like Ease My Trip for internet ticketing, Varun Beverages for packaged drinking water and Devyani International for catering, and taking 50% premium in the valuation multiple given IRCTC's monopoly, we see the stock close to its blue sky fair valuation. However, this exercise does not capture the value of future business potential like payment gateway, private trains, etc. But IRCTC, in a way, is a very unique offering. If the government does not tinker with its monopoly position, it deserves a look, and investors should add the stock in the event of a meaningful correction.